If you're retiring in 2026, your income picture may look different than you expected, even if your savings and benefits haven't changed. There are three adjustments happening this year that could impact how much you actually receive from Social Security, how much you pay for Medicare, and how much you owe in taxes. Let's walk through what's changing and how it affects your planning. Hi, I'm Mark Ahrens, president of Money Managers Inc., a financial services and tax firm. And if you want to explore how these applies to your own situation, there's a link below where you can book a conversation with us. Every year brings adjustments to Social Security, Medicare, and the tax code. Some are automatic cost of living increases. Others are just the results of a legislation or schedule changes that were set years ago. For someone retiring in 2026, these changes can affect your cash flow, your tax liability, and your overall retirement strategy. Understanding them now gives you time to adjust if needed. If this applies to your situation, go ahead and hit the like button and subscribe for more retirement guidance. Let's get into it, shall we? Social Security COLA for 2026. The first change is the Social Security Cost of Living Adjustment, or COLA, for 2026. Each year, Social Security benefits are adjusted based on inflation as measured by the Consumer Price Index. The 2026 COLA is 2.8%, which is significantly lower than the increase we saw in 2022, 23, and 24. Now, for context, the 2023 COLA was 8.7%, the 24 COLA was 3.2%, and the 2025 COLA was 2.5%. So we're seeing inflation cool, and the adjustments are reflecting that. What does a 2.8% increase actually mean in dollar terms? If you're receiving the average Social Security benefit of around $1,976 per month, a 2.8% increase adds about $56 per month, or roughly $672 per year. If your benefit is higher, say $3,000 per month, you're looking at an additional $84 per month, or about $1,008 per year. That's helpful, but it's not transformational. And here's the important part. The COLA is designed to help benefits keep pace with inflation, not to increase your purchasing power. If your actually living expenses are rising faster than the CPI, which can happen depending on your spending patterns, you may still feel the squeeze. This is especially true for healthcare costs, which often rise faster than general inflation. So while your Social Security benefits go up 2.8%, your out-of-pocket Medicare expenses could be increasing at a higher rate. For someone retiring in 2026, this means you'll want to build a retirement income plan that doesn't rely solely on COLA adjustments to maintain your lifestyle. Having flexibility in your withdrawal strategy or other income sources becomes important over time. Medicare premium changes. The second change involves Medicare premiums, which directly affect how much of your Social Security benefit you actually keep. For 2026, the standard Medicare Part B premium is $202.90 per month. That's up from $185 in 2025. So if you're enrolled in Medicare and having your premium deducted from your Social Security check, you're paying about $18 more per month than last year. Now, remember that Social Security COLA we just talked about, if your benefit increased by $56 per month, but your Medicare premium went up by $18 per month, your net increase is only $38 per month. That's the reality of how these adjustments interact. And that's just the standard premium. If your income exceeds certain thresholds, you'll pay IRMAA surcharges, income-related monthly adjustments amounts, which can add hundreds of dollars per month to your Medicare costs. For 2026, IRMAA kicks in for individuals with modified adjusted gross income above $109,000 or $218,000 for married couples filing jointly. These thresholds are based on your tax return from 2 years prior, so your 2026 premiums are determined by your 2024 income. If you had one-time spiking income in 2024, maybe from a Roth conversion, a large bonus, or the sale of a property, you could be paying higher Medicare premiums in 2026. Even if your current income is lower, you can appeal this through Medicare if your income has dropped due to a certain life events, but it's something to be aware of. For someone retiring in 2026, this is a reminder that Medicare isn't free, and the cost can vary significantly based on your income. Part of your retirement planning is understanding how much of your Social Security benefit will actually hit your bank account after Medicare premiums are deducted. Tax laws changes. The 2017 tax cuts made permanent. The third change is one of the most significant and is actually good news for retirees. The tax provisions from the 2017 Tax Cuts and Jobs Act have been made permanent. In July 2025, Congress passed the One Big Beautiful Bill Act, which I'm sure you've heard about, which extended the individual tax rates and deductions from 2017 indefinitely. This removes a major source of uncertainty that was facing retirees at the end of 2025. What does this mean in practical terms? The current tax brackets are like 10%, 12%, 22%, 24%, 32%, 35%, 37% will continue into the future. The higher standard deduction that married couples have been using, $32,200 for 2026, is now permanent and will continue to adjust for inflation each year. For someone retiring in 2026, this means the tax landscape is now more predictable. You can plan your retirement distributions, Roth conversions, and other tax strategies with more confidence, knowing that these rates won't suddenly jump at the end of the year. The law also made some enhancements. The lowest tax brackets, 10% and 12%, receive an additional inflation adjustment for 2026, which means slightly lower taxes for most people. And there is a new charitable deduction for non-itemizers, up to $1,000 for single filer and $2,000 for married couples. There were also changes to the state and local tax SALT deduction cap, which increased from $10,000 to $40,000 for 2025 through 2029, though this phases out for higher earners. For retirees, the bottom line is this: the tax environment you're retiring into is now more stable and predictable than it was a year ago. The uncertainty around expiring tax provisions has been resolved, at least for the foreseeable future. That said, tax planning is still important. Having a mix of taxable, tax-deferred, and tax-free accounts gives you flexibility to manage your tax liability regardless of what rates might be in the future. Why this matters for your retirement plan. These three changes, Social Security COLA, Medicare premiums, and tax law adjustments, all affect different parts of your retirement income. They don't happen in isolation. They interact with each other. Your Social Security benefit goes up, but Medicare premiums take a portion of that increase. Your tax bracket changes, which affects how much you keep from your IRA withdrawals, and if those withdrawals push your income over certain thresholds, you could face higher Medicare costs in the future years. This is why retirement planning isn't just about having enough saved. It's about understanding how income, taxes, and benefits fit together and adjusting your strategy as things change. For someone retiring in 2026, the goal is to structure your income in a way that maximizes what you keep after taxes and Medicare premiums, while also maintaining the flexibility to adapt as laws and circumstances change. That might mean delaying Social Security to let your benefit grow. It might mean doing Roth conversions while you're in a lower tax bracket. It might mean managing your taxable income carefully to stay below IRMAA thresholds. Or it could mean a combination of all three. There's no single right answer, but there is a right approach, and that's planning with the full picture in mind. So to recap, if you're retiring in 2026, you're facing a 2.8% Social Security cost of living adjustment, higher Medicare premiums, and the performance of tax rates from the 2017 tax law, which provides stability for your planning. Each of these affects your retirement income in different ways, and understanding how they interact can help you make better decisions about when to claim benefits, how to structure withdrawals, and how to manage your tax liability. These aren't reasons to panic, but they are reasons to have a plan in place. If you're approaching retirement and want to make sure your plan accounts for these changes, you can schedule a conversation using the link below. Thanks for watching, and I'll see you in the next video.